Hello, and welcome to our YouTube channel. In this video, we'll delve into the basics of mutual funds. Understanding these fundamental concepts is crucial before you start investing. So, let's dive into the world of mutual funds. What is mutual fund? A mutual fund is a professionally managed investment vehicle that pools money from multiple investors to invest in a diversified portfolio of securities, such as stocks, bonds, or a combination of both. The fund is managed by a team of experienced professionals, known as fund managers, who analyze the market trends, conduct research, and make investment decisions based on their expertise and the fund's investment objectives and make investment decisions on behalf of the investors. When you invest in a mutual fund, you purchase units or shares of the fund. Each unit represents your proportional ownership in the fund's portfolio. These units have a value called NAV. Net asset value, NAV. The net asset value represents the per unit value of the mutual fund. It is calculated by dividing the total value of the fund's assets minus liabilities by the number of outstanding units. Each mutual fund has specific investment objectives, such as capital appreciation, income generation, or a combination of both. These objectives determine the fund's investment strategy and the types of securities it invests in. There are various types of mutual funds, including equity funds, invest primarily in stocks, aiming for long-term capital growth. Debt funds, primarily invest in fixed income securities, such as bonds and treasury bills, focusing on generating income. Hybrid, balanced funds, allocate investments between both stocks and bonds to achieve a balance of growth and income. Index funds, mirror the performance of a specific market index, such as the S&P 500. Sector funds, concentrate investments in specific sectors, such as technology, healthcare, or energy. International funds, invest in securities outside the investor's home country, providing exposure to global markets. Income distribution, investment returns. Mutual funds generate income through dividends, interest, or capital gains from the securities in their portfolio. This income is distributed among the investors based on their holdings. Expenses and fees. Mutual funds charge fees and expenses, primarily the expense ratio, which covers fund management, administrative costs, and marketing expenses such as entry load, exit load and stamp duty. Before starting your investment, here are some essential tips for successful mutual fund investing. Define your investment goals. Clearly identify your financial goals, whether it's wealth creation, retirement planning, or funding a specific objective. This will help you choose the right type of mutual funds that align with your goals. Understand your risk tolerance. Assess your risk tolerance and determine how much volatility you can comfortably withstand. Different mutual funds carry varying levels of risk, so it's essential to choose funds that match your risk appetite. Research and select the right mutual funds. Conduct thorough research on different mutual funds available in the market. Consider factors such as fund performance, historical returns, expense ratios, fund manager experience, and investment strategy. Look for funds that have a consistent track record and align with your investment goals. Diversify your portfolio. Avoid putting all your eggs in one basket by diversifying your mutual fund portfolio. Invest in funds from different asset classes, sectors, and regions. Diversification helps reduce the impact of any individual fund's poor performance and spreads the risk across multiple investments. Regularly review your portfolio. Monitor the performance of your mutual fund investments periodically. Keep track of how your funds are performing relative to their benchmarks and other similar funds. If a fund consistently underperforms or no longer aligns with your investment goals, consider making necessary adjustments. Avoid over-diversification. While diversification is important, it's also essential to avoid over-diversification. Owning too many mutual funds might lead to overlapping holdings and dilute the potential returns. Maintain a balanced portfolio with a manageable number of funds. Understand the tax implications. Be aware of the tax implications of investing in mutual funds. Different types of funds have varying tax treatment, such as capital gains taxes on redemptions or dividend taxes. Consult a tax professional to understand the tax implications specific to your situation. Invest for the long term. Mutual funds are best suited for long-term investment horizons. Avoid making hasty decisions based on short-term market fluctuations. Stay focused on your investment goals and give your investments sufficient time to grow. Consider systematic investment plans, SIPs. SIPs allow you to invest a fixed amount regularly in mutual funds. This disciplined approach helps in rupee cost averaging, where you buy more units when prices are low and fewer units when prices are high. SIPs are especially useful in volatile markets. Stay informed and educated. Keep yourself updated on market trends, economic indicators, and news related to your mutual fund investments. Continuously educate yourself about investing concepts, fund performance metrics, and industry developments. This knowledge will empower you to make informed decisions. That concludes our discussion on the basics of mutual funds. Remember, mutual funds offer investors an opportunity to access professional management and diversification. However, investing in mutual funds involves risk, and past performance is not indicative of future results. It's crucial to do thorough research, consult with financial professionals if needed, and align your investments with your financial goals and risk tolerance. In our next segment, we'll explore the steps involved in investing in mutual funds. Stay